Nick, good to see you. Important question. Do you need life insurance if you're retired? I think a lot of people think they don't, and their hesitation makes sense, right? You're no longer working. The kids are probably grown and out of the house. You just don't have the same financial responsibilities that you did when you were younger. But what do you think? Do people need life insurance if they're retired?
So I'm going to go off a little bit just because, I've been doing radio for 10 years, even
Mm-hmm.
longer than that. And like in the past week, I've been listening to shows where the blanket advice of the people, the host of the show is, hey, if you're over 55, you don't need life insurance anymore
Right.
for the reasons that you said. So just trash it away. You don't need it. It's almost like it's this, it should be the advice for everybody, like the sage advice, like the rule of thumb. And to be honest with you, I think that's completely probably not the best way of looking at it. And it says all revolving around life insurance. Sometimes you'll see people that are beyond there saying, oh, yeah, you know what? You should do an 8% withdrawal rate on your investments, and that's going to work out. And, you see this type of advice, and I start to scratch my head, and I wonder, is that actually really good advice? Like, I don't. I think that if you think about it, I don't know about you, Erin, but I don't know when you got life insurance. For me, I was in my 20s. Now, I don't know if that's when
having kids.
yeah. So, and that's when typically people will get life insurance is when they're in their 20s. And so what ends up happening is what's the probability that you're going to walk out on life, die when you're 20 or 30 years old? What's the probability?
Hopefully small.
Very, very small, right? For most Americans, very, very small. But then what happens when we hit 60 and 70 is we listen to this advice, we get rid of life insurance. And what is the probability when you're 70 or 80 years old that you're going to walk out on life? Is it higher that you're going to die then than when you're in your 20s and 30s?
Certainly.
Absolutely. And that's when you'd likely use this life insurance that you just got rid of. And so you almost have to look at it from that lens. And another thing too, life insurance is an income replacement. If you are married, and let's say that you have $6,000 of Social Security income and $4,000 of income coming from a pension. I saw a case recently, a couple had $10,000 of income coming in. It's awesome, $10,000 of income. However, if one person walks out on life, the husband, the spouse only got to keep one Social Security income. That means their income went from $10,000 all the way down to $3,000 of income. And if they got rid of their life insurance, how do you replace that income? I guess you could say, well, I have a 401k and I have an IRA, but those incomes are taxable. Life insurance is tax-free. So I just want you to be careful. This isn't, I'm definitely not saying everybody needs to have life insurance. I'm not on that bandwagon. What I'm saying is let's think about this from the lens of when you would likely need it. And is there a reason why some people say you need to get rid of this at a time in your life when you're likely to use it the most? There's a reason there's commercials now that will say, hey, we'll pay you X amount of dollars if you're retired to buy your life insurance plan. Why would they do that? Because they know it's going to be something that's going to pay out. We can't get rid of two things, death and taxes.
Let's make a distinction real quick before we move on between term and whole life insurance, right?
So that's a great way to, because everybody thinks life insurance is the same no matter what it is. And there's almost a third one I'll throw in there, which is group insurance. So if you think group insurance is the insurance that you have when you work at a company, and usually when you leave, it stays at the company. So as soon as you retire, your insurance goes away. Term insurance is where you're buying it for a particular period of time. So for instance, if you buy a 20-year term, let's say you're 40 years old, you buy a 20-year term. It's going to cover you from 40 to 60 years old, and at 60, it goes away. And then you have permanent insurance, or sometimes they call it whole life insurance, and that lasts for as long as you're going to pay the premium. It lasts for the rest of your life. And so when I was in college, I went to Miami of Ohio, and the story about all that. But anyway, when I went to school there, the teacher, I still remember, said, oh yeah, here's the strategy, kids. When you go out in the real world, you're going to teach your clients that you want to buy term and invest the difference. Works really good when you're talking to a bunch of college students, because college students are healthy. Problem is, buying term and invest the difference. That's great when you're 20 and you can buy 30-year term. But when you're 50, you got to be insurable again. If your health isn't so great, that's a problem. But let's say, for instance, you got term insurance until age 70. What's the probability at 70 you're not going to have some medical situation that makes that term insurance astronomical?
Hmm.
So you got to be careful of that type of strategy too. Buy term and invest the difference. Great when you're young, not great when you're old. So sometimes it might make better sense to get permanent insurance when you're younger. So when you're older, it's there and you don't have to try and hope that your health is good later on.
Hmm. Hmm. I know you value helping families create a lasting financial legacy, which life insurance can certainly help ensure.
Well, and if we think about the Rockefellers, if we think about the Forbeses, we think about the Kennedys, even, they knew how to, and everybody's like, well, how did those families pass on money from generation to generation to generation? Because they realized how to leverage a dollar. How can they make $1 worth $10 and have that $10 pass on to their beneficiaries tax free? That's what they got good at. Well, they realized life insurance is the avenue for that because the tax code's written, good for that type of circumstance. The problem is now is if you get rid of life insurance and you don't have that to pass on, most people are passing on 401ks and IRAs to their beneficiaries. Uncle Sam is not going to walk up to your beneficiaries, your kids, and say, hey, you know what? Mom and dad died. We feel really bad about that. The $1 million that you have in the IRA, we're going to let you guys take that money without any taxes. Uncle Sam's not going to say that. What Uncle Sam's going to do is he's going to say, hey, you got $1 million in pre-tax accounts. 30% is taxes. So you're going to owe us $300,000 and you get to keep $700,000. So that's why these wealthy families know the tax inefficiency of those investments. And that's why they will hang on to life insurance longer than most other Americans after they've listened to some radio show saying, get rid of it, get rid of it. Well, that might not make the best sense for a lot of people.
Mm-hmm. And of course, we have to talk about the cost of healthcare, specifically long-term care when you're retired. 7 out of 10 people will need long-term care at some point in their life. And this, Nick, looking at the costs near you, projected about 10 years out, ranging anywhere from $5,000 a month to $15,000 a month, which is why you suggest, people consider life insurance with a long-term care rider.
Well, and so that's the thing is there was a study done by I think it was the U.S. Department of, I want to say housing or something like that. And they tried to figure out what's the probability somebody's going to use long-term care. And they said 7 out of 10 people are actually going to need it. 7 out of 10. And if you look at this and you look in that bottom right-hand corner where it says private room, 2034 cost for a private room, $15,000 for a private nursing home room. I mean, we're talking a astounding amount of money.
Yep.
And so a lot of people have been told, hey, you can just self-fund. Just worry about it later. The chances that you're going to need this is not very big. So just self-fund. Can you imagine having to self-fund a $15,000 per month expense?
No.
If you're married and you still got to worry about how do I pay for my at-home spouse? I'm in the nursing home, but how do I pay for taking care of that and the house and the expenses of all that? So self-funding, I think if you actually look at it, could be a very costly venture. So a lot of people will say, well, yeah, but I've heard about traditional long-term care, Nick, and I don't like that either. And I don't either. Traditional long-term care is like a black hole. It's like car insurance. You got to pay money into it with the hope that you might actually use that benefit at some point in the future. And so once that cost is gone, once that expense, once you pay that money into it, you might not ever see it again. And so that's why I don't typically like that. And traditional long-term care can start here, and then every month or every year, rather, they can hike that rate up, and you can't control that. So what a lot of people will do is they've gotten into hybrid plans, like a hybrid long-term care plan that's latched on to an annuity, where that might be like, hey, this annuity is paying you $4,000 a monthly income. But if you can't complete 2 of your 6 activities of daily living while you're getting that income, we're going to double it. Instead of $4,000, you're going to get $8,000 of income for maybe up to a 5-year stretch. So you have those benefits that have caught on a lot in the last couple of years. And then you also have long-term care that's attached to life insurance. And I think this is the one that most people don't know exists, because most people think, if it was me, life insurance, well, that only insures if I die. And if I don't die, I get nothing. Now policies are coming out saying, well, no, we'll structure this different. If you have $500,000 in life insurance benefits and something happens to you and you need it for long-term care, what we'll do is we'll allow you to attach to that $500,000 of benefit. Maybe we'll let you get to $400,000 of that benefit if you need to, and you're still living for long-term care. So you can still have this bucket of money and attach yourself to it if you need it for yourself. But if you never do, and you're in that 30% that don't need long-term care, at least there's something passing on to your family, and it's not like this black hole that just went away.
Yeah, use it or lose it. Good point. I'm glad we had the time to talk this through, Nick, because again, I think we're breaking down a few misconceptions. If somebody wants to talk to you about whether or not they need life insurance and designing a policy, what's the best way to reach you?
The phone number is the best, 800-245-844 Group 10. How about that? Didn't even know my own phone number.
I know, sorry.
Well, there is 800-245-0546. There is 844 Group 10. I just didn't know which one you were throwing up there. But that's one way to schedule a time to get together with us. And all we can do is, it's really important to do a life insurance analysis, almost like a stress test on your life insurance plan to see if you even need it. Because let's be honest, if you have no kids and you have no spouse, and you don't even know who your beneficiaries are because you don't know who you'd want to leave your money to, maybe life insurance isn't the best bet. But if you have a spouse to take care of, and you have expenses at the house, and you have kids that you want to help out, and kids for grandkids, it might be beneficial. And that's why getting a life insurance stress test can be important. So again, you can go to our website, group10financial.com. Again, 844 Group 10, or that other number that I threw out, 800-245-0546. Either way, gets you to the same place. And then we can help you and figure out what's going on, and if you need it, and what can be done to make it maybe even more optimal for you.
All right. Nick, thank you.
Great being with you, Erin.